But when you die, because you will die at one point, the death benefit is going to replenish the amount that you put out plus more. And so that's how they're able to perpetuate the wealth inside that trust, leveraging life insurance. So there's a lot of different ways that you can leverage life insurance outside of just the death benefit. Equity is a main piece that you can leverage while you're living, and it's great to take advantage of certain opportunities while you have access to the cash.
Okay, so let's talk about that. And that's something Ben and our family put in play. I don't know, it's probably been about 7 years ago where we had our trust set up and then we set up um, whole life policies and then also index universal life policies where we can borrow from them, still earn interest on that money, pay the money back. Let's talk about that a little bit, and we do have people that can help you set those trusts up. Recently, that trust system kind of came up under fire over the last year, where a lot of accountants that were offering it now can't offer it because they really tried to change the game up. Because I just kind of noticed when everybody started getting on stuff, that's when they kind of started changing the game up. You still can't do
Mhm.
it, but you got to really make sure you're getting with people that really know what the heck they're doing, not just setting it up, but then making sure that you get accountants that know how to file it properly, because how you file traditionally and how you file a business trust and family trust and charitable trust and private family foundation is very, very different. And so it's not anything you want to just say, oh, I'm gonna let my accountant do it. He gonna watch YouTube or read a book. You need to really make sure that he understands the tax codes and the tax laws. But even if you don't have the trust set up, you can still borrow against the insurance policy for maybe a down payment on something or invest in an asset. But ideally, when you borrow against that insurance policy, it should be used to multiply the money. It should be used as an investment, not vacation or people it's your money, so you literally can use it for whatever. But I really, really want to stress that needs to be used to multiply and make more money. Okay, so now, Sean, what are some of like your favorite insurance policies? Is it the whole life this your fave or the IUL this your fave? And who wrote the book? What with the
Say that one more
Rockefeller?
time, Jewel. You broke
Who
up a
wrote the
little bit.
book? Also, who wrote the book of what
It's
was it?
by Garrett Gunderson.
Garrett Thunderson?
It's by
THU?
Garrett Gunderson. Mhm.
Okay.
Yeah, Garrett
Okay.
Gunderson.
Okay, bet. Okay, thanks. All right, so which one are your faves?
Mhm.
IULs or whole life?
No problem. It really depends. It really depends on a lot of things, right? I would say ultimately what you want to get the plan for, right? Depending on if you're risk averse or not, whole life tends to grow safely and permanent in nature. All the universal plans tend to have a little bit more aggressive growth in them. So it really kind of depends on your appetite, and I would say what you want to leverage the policy for. If I'm if I'm looking to leverage the life insurance policy to where I want that equity to be steady in growth, I would probably and a little bit of death benefit focus, I would probably level whole life. If I wanted some the potential for return, I would leverage some of the universal life plans. It just kind of really depends on your appetite. I have both. I have a lot of different types because I have a lot of different goals that I want to leverage the plan for. So it really kind of depends on what you wanted to use it for. And
Okay,
and
so
what I like
let's
about it is,
yeah. Go ahead.
no, I was going to say what I like about the equity inside of a life insurance policy is to your point earlier about using it for growth. It's really just math. Okay, so you have a life insurance policy and it may be growing at 5, 6, 7, 8, 9, 10%, depending on how you design it. But then you borrow your money from it, so you want to make sure, right? When you pull that money out, that you've done the math, you've done the research to where if I take out 40 grand and I put it into another project, that project is going to be giving you some return better than the rate at which you borrowed from, you know? And a lot of times when you do the math, most of the time, not all the time, there aren't other lending terms that can give you a better rate than if you were to borrow from a life insurance policy. So if you were to go to a bank nowadays, they may give you money at 6-7%, right? Depending on what the type of loan, right? But I would say 8 times out of 10, that rate is higher than the net rate of when you're pulling from your life insurance plan. So it's a lot of, I would say, just make sure it makes sense financially, mathematically, before you just, to your point, pull it out money, just kind of using it over here with no purpose or intention. You want to make sure you have a plan in place and that money is working for you, to where when you get done with that project and you have some cash, you can put it back in your insurance plan and you're ready for the next one. You can be your own hard money lender, if you will.
Mm-hmm. Absolutely. So basically what you do is you'll look at a person's age, you'll look at their health, you'll look at the monthly fee that they're actually going to start to pay into the premium, and then you'll kind of calculate the numbers and do an evaluation and come back and say, hey, this will get you, this amount of money if you invest this amount, or if you pay this for so many years. How many years on average do you need to pay into the average policy, or is it totally dependent on your age, or what?
It depends on your age, your health, how much you put in, and I would say when you want to pull it out. There are some plans, if you design it correctly, where you can have money, access to the money after year 1. Okay. And then there are some plans where it takes, 6, 7, 8, 9, 10 years. It all depends on how much you're willing to put in. And so think about it like a mortgage, since we're on the real estate track, right? So you have a 30-year mortgage, right? And normally the 30-year mortgage, the monthly requirement is cheaper or less expensive than the 20-year mortgage. Okay. So the insurance plan works very similar, to where you can pay into it for an extended amount of time with lower premiums, or you can shorten that time with higher premiums. Okay, they have access to the same amount of capital. Mm-hmm. So again, these insurance plans can be designed very uniquely, and so it takes someone like myself or somebody who's in the industry to ask really good questions to understand exactly what you're trying to achieve, and that they can customize the plan based on the goals and how you want to leverage that plan.
Yeah, and I think I know I asked you the other day. I don't know if you got a chance to take a look at it. I told you I paid into a plan where I just paid into it for 5 years, an aggressive amount of money. And, now I don't pay into it anymore. I paid into it for 5 years. Then the insurance company is going to match it for 5 years. And it's going to sit for another 5 years and accumulate. And then after that, I can start pulling, and I'll be able to pull every single year a certain amount of money being paid to me. IULs, so with whole life policies, I like it because it can work as a form of retirement for you. But now help me out a little bit. I believe the IUL, from a retirement standpoint, payment coming to you every single year after so many years, it's designed to keep paying you until you die. Then after you die, you still get a death benefit, but it'll just be reduced based on how much was paid out to you. Does that make sense?
Correct. That's, yep.
Okay.
Yep. And a lot of our clients leverage. Go ahead. So yeah, a lot of our clients leverage that same that same strategy that you just described. So 2 things I want to mention.